Equity markets are waiting for the Fed to make its decision this week on what it's going to do. Are they going to lower rates 50 basis points or 25 basis points? That seems to be the question. The futures are betting about 50-50. Similar amount think it's 25, similar think it's 50. The reality is nobody knows. But whatever it is and whatever spin they give it will affect the equity markets. Hi, I'm Ben Reppond. Today is September 17, 2024. Welcome to my YouTube broadcast. So I'm going to, because the equity markets have basically been going up quite a bit, a couple of down days, I think, but anticipating the Fed action. Are they going to, and what are the comments that they're going to make after they take that action? The markets are favorable right now, and we will see this week what happens. So I thought I would cover this, and I thought I would give you two perspectives. The first perspective is from Mike Wilson. Mike Wilson, Chief Equity Strategist for Morgan Stanley. He is going to give his view. Now, I like Mike Wilson. There are people who think he is perma-bear, bearish view of the world. Not really. I mean, I've heard him take bullish views and bearish views, depending on his view of what's going on at the time. So to paint him as a perma-bear is too much, I think. But he gives his view of it, and it's kind of it's a bearish view. But because I've heard him give opposite views, I view him as more of an independent thinker. So he is giving kind of a cautionary view that where we are headed from here for a period of time is a slow growth environment. He's not saying a crash. He's not saying the market is going to have, a deep decline. He's saying because of all the issues out there, he makes the case for the fact that it is going to be a slow growth from here. Now, that could mean some kind of decline, but I don't read into it means a crash. But I thought I'd give you that view. Then following this, I'll give you some positive views, and I'll introduce those at the time. But I wanted you to hear from Mike Wilson, and he makes a good case for it. So listen to this, and if you think that the market is probably in a slow growth period, maybe even in, I won't say negative growth, but it's not in a growth environment, then you'll probably appreciate what Mike Wilson has to say. Take a listen.
I mean, a lot has happened. I mean, it's the same thing. You look at the index, like, well, nothing's happened. I mean, a ton has happened. And I want to go back to early July, actually. That's when we got the first soft CPI number. And that's when the yen bottomed, meaning, 165 was the bottom relative to the dollar. And that was the beginning of this sort of unwind of this idea the Fed was actually probably behind the curve. Okay, inflation was coming down. So we wrote about this at the time. We said, be careful what you wish for. I mean, inflation coming down that quickly is another sign that demand is weak. It's another sign that growth is poor. And look, I mean, the growth surprises have been on the downside now really since April. I mean, it's been a precipitous decline in kind of economic surprises. And now inflation is disappointing on the downside. So let's go back to early July. I think we were on another program. We said there'd be a 10% correction before the election. Lo and behold, it started the next day. We got a 10% correction, whatever. I think we're still in this period, though. We got it quick, but it doesn't mean it's over. I think we're in this period between now and basically the election, which includes another earnings season, another couple payroll reports, and the Fed kicking off its rate cutting cycle. That's a lot of action where the market's going to remain extremely volatile, kind of like today. So back to early July, we start to sell off. The yen starts to basically rally against the dollar, some deleveraging going on there. Then we get what I would call in line to maybe slightly disappointing results from the AI names. Okay, hyperscalers in particular, people not that happy with the amount of money they're spending, and the return on capital is not particularly impressive. So those stocks all kind of rolled over, and that has continued, by the way. Those stocks are now well off their highs. So the AI kind of theme I think has lost its luster. Many of our institutional clients have actually divested from that, theme to some degree. Then, of course, we got the events at the end of the month where we had the negative payroll number, not negative, but disappointing payroll number, and that was really a shot, which then got the carry trade to really unwind. The Nikkei was down 20%, sort of top to bottom in a very short period of time, and then everybody kind of went back to everything's great. I'm glad that's over, and I'm just not in that camp. I think it's just beginning. I think, and what's beginning is just more acknowledgement that we're closer to the end of the cycle than what perhaps the S&P 500 is saying at 5,500. So what has actually happened is the following. You talked about currency. So currencies, right? The dollar has been weak against most major currencies now for a couple months, and they have not recovered. I mean, the dollar is still kind of at its lows, particularly against the yen. So that has not bounced at all. The other markets, the other macro markets that I focus on, commodities in the tank, okay? I mean, literally in the tank. And then, of course, rates. So now 2-year yields and 10-year yields are probing new lows. 2-year yield spread to Fed funds is as wide as it's been in 40 years, 190 basis points, which is basically the bond market telling the Fed explicitly, you are behind the curve in a big way. Meanwhile, S&P, tried to get back to new highs, didn't quite get there, but we're still closer to highs than the lows. But internally, okay, and this is what we focus on, internally in the stock market, small caps are still nowhere, and defensive stocks now are killing it. So if you look at some of these low beta defensive stocks, I mean, they're on a flagpole. And that is not a good sign. So in other words, all these markets actually do agree, whether it's currencies, commodities, rates, and the internals of the equity market, all agree that growth is the problem. And it's probably a bigger problem than what the mainstream media is talking about.
So next I want to play a positive view, and this is from Ed Yardeni. He's in New York. He does research. He sells his research to the institutional clients on Wall Street, and he says that interest rates, are normalizing. They're coming down, but they're hitting. When you look at the long-term view of interest rates, we are approaching a normalized or normal kind of rate. And instead, the Fed, clearly wants to, Jay Powell clearly wants to get to a 2% number. 2% is below normal. But he says if we go to normalized rates, which he thinks we're in or approaching, that he says that's basically good, and that he says or implies that we are probably headed for some kind of, during this correction, then we're headed for some kind of a up market from here, and he makes a case for that. So it's a little different view, definitely a different view than Mike Wilson. So take a listen to Ed Yardeni.
I want to ask you about the economic landscape at a high level, at least for someone like me who hasn't seen this before. What we've been through is obviously been very interesting. I mean, we had COVID, we had high inflation, it's come back down. Can you just talk about where you think we are right now?
I think we're normalizing. There's been a lot of controversy since 2022 about whether the tightening of monetary policy as in response to the surge in inflation, uh, uh, what the consequences of that would be. And the widespread perception in 2022 and 2023 was that we would clearly, obviously, have to fall into recession. And that was in our position. That we thought the economy would prove to be resilient for a number of reasons. And here we are again in 2024. We're getting near the end of it. But throughout this year, there's been still lingering concerns about a recession and perception that the Fed has to get on with lowering interest rates rapidly or we'll fall into recession. Our view has been that the Fed, yes, sure, they tightened interest rates, they tightened monetary policy in 2022 and 2023, but they also normalized. I mean, they raised it from 0 to 5.25%. Everybody said, well, they raised it 525 basis points. They raised it from 0. And if you look at the charts, 4 to 5% is kind of where interest rates were in the good old days, the normal days. And I'm talking about before the great financial crisis. So I think we're just normalizing, which is worked pretty well in terms of thinking about the markets. And So, everybody, when an indicator comes out and it looks on the weak side, everybody jumps on it and says, there's the recession now. We say, well, hold on, let's look at this a little bit more closely. We did that with the past two employment numbers and came to the conclusion that, this is not going to set us up for a recession. And yeah, the Fed's going to is that this time around there has been no credit crisis because the Fed is much more adroit at playing whack-a-mole in the financial markets. When something blows up, they create a liquidity facility. So I think that has to be taken into consideration, into account in explaining a lot of this monetary policy cycle and business cycle.
And finally, I want to play a piece from Stephanie Link. She also has a positive view. Hers is a little more tied to the chip sector, AI. She sees that as driving a positive market in the coming period of time. I'll say the number of years. But when you get into the AI space and the chip sector, they go way up and they go way down. So it's a rough ride in that. So if we have some kind of correction, even though she may be right, over time, it's not smooth sailing. So, but anyway, she makes a case for that, and I thought I'd play this. So again, it's more of a positive view, contrasted with Mike Wilson. So take a listen to Stephanie Link.
Steph, he used the word great yesterday here in San Francisco at the conference that we, of course, were broadcasting live from when he talked about demand. But, Josh spoke about more broadly the semis, which were one of the weakest parts of this market. It led to the feeling that there was a lack of stability with the technology trade. But here we go, week to date, Broadcom, for example, is up 20% this week. That's better than NVIDIA. Marvell's up 13.5%, AMD 11.5%, Taiwan Semi 9%. You want to look at the foundation of where this stability feels like it's coming from? Look no further than the semis.
Right. And Scott, I think that has to do with the fact that across the board, and all the names you just mentioned, and then a whole host of others, they all beat earnings. They all grew total revenues at the minimum. AMD was the weakest, and it was up 10% in terms of revenues. But you had across the board Qualcomm and Lam Research and TSMC. I mean, the numbers were phenomenal. And Broadcom also was pretty phenomenal. Their AI business in their quarter grew threefold year over year. Their VMware business is growing $4 billion on a revenue run rate basis. Those two pieces within Broadcom represent over 50% of total revenues. And then add on, at Goldman Conference, they're very, very bullish about their business, and they're reiterating all kinds of great targets. I mean, their AI business at the beginning of this year, Scott, was $7.5 billion. That was their target for the full year in AI. They're now at $12 billion. And that's just, these numbers are crazy. They're great. And so for me, when it fell last Friday, 10%, on Monday I added to it. I added again to it yesterday because I don't think it's fully appreciated, because I think everybody gives all the credit in the world to NVIDIA, which they should. It's a wonderful company, been a great stock, but there are other names to play as well, especially when I don't think it is as appreciated in the marketplace. And I have a cyclical driver on top of AI and VMware. I have their cyclical businesses, right? Networking and broadband and storage. That is actually at a trough. And I think, based on the last two quarters, that business seeing order growth of 20% in each quarter, that bodes well for next year and the earnings power on top of this other momentum. So to me, that's the one that I have been betting on. It's done well for me. It's up 94% in the past year. So I have definitely a lot of exposure in this theme, and I just think this one is the bet that I'm going with.
Well, the cartoon says, I'm long Titanic, and damn it, I'm staying long Titanic. So the bulls may be right in the long run, but as the cartoon depicts, it may be a rough ride. Thank you for watching. If you have any questions or comments, leave them in the comment section below. Thanks.